Hi, I'm Aaron Backay, and today I want to talk about mutual funds and ETFs. When you first start learning about investing, it can feel like you've dropped into a new language. One of the most common questions people ask is what's the difference between a mutual fund and an ETF? At a high level, both investment vehicles are ways to pool your money with other investors so you can own a basket of investments, stocks, bonds, alternative investments, etc., without having to pick and manage them one by one. However, the way they work behind the scenes is a little bit different, and those differences can matter. Maybe an illustration will help illuminate the nuances of these types of investments. Think of mutual funds like a chef's special at a restaurant. You sit down, you order the special, and the chef decides what goes on the plate. The mutual fund owner is investing in the chef's experience, their objectives, and a track record of making the sort of meal you hope to want to consume. The meal is served once at the end of the day, and everybody who ordered it pays the same price per serving based on what the ingredients cost when the kitchen closes. Now let's talk about ETFs, exchange traded funds. If mutual funds are the chef's special, ETFs are more like a buffet. You can walk up anytime the restaurant's open, pick what you want, and pay the going price. The typical passive or index driven ETF is more like a fixed menu, where the chef's job is to keep the buffet stocked with an expectation of following a certain theme. So, what do they have in common? Well, both provide you with diversification. You can own a slice of hundreds of companies with one purchase. Both are run by professional managers, although many ETFs are passive or they track an index like the S&P 500 or the aggregate bond index. But both can be cost-effective ways to build a long-term portfolio without having to pick individual stocks. And they also have differences. Trading. Mutual funds are priced for trading once a day at market close. ETFs trade all day long. And then costs. Mutual funds sometimes come with higher fees or sales charges, though many low-cost index funds exist today. ETFs generally have lower expense ratios, no sales loads, though you may pay a brokerage commission depending on the platform that you're using. And then many mutual funds actively manage the companies or funds they invest in based on the investment thesis, while ETFs generally follow certain indexes. They may require less hands-on work by the manager. So your question should be, which is right for you? The methodology, goals, timeline, or investment ethos held by you or your financial advisor may dictate your use or balance of these investments. And if the preference is low correlation to the markets, typically active management of mutual funds may be helpful for certain allocations. But if it's to passively track and follow the markets, indexing in ETFs may be worth considering. So the truth is that many investors use both. If your money manager builds a long-term strategy, thoughtfulness around these mutual funds and ETFs is an essential ingredient to filling up your plate. So my final thoughts are this. Both mutual funds and ETFs are tools or options for building your meal out. Neither is better in every situation. The best choice depends on your goals, your style, and the methodology of the investor or wealth manager. So the next time you hear those acronyms thrown around, you know mutual funds are the chef's special, ETFs are the buffet line, and both can fill your plate in the right kind of portfolio. Thank you for watching. If you like this video, give this video a thumbs up. Be sure to subscribe and tune in for our next episode of Coffee and Cash.